What's going on, everybody? Cullen Gandy here, coming at you with another video. This one mainly geared towards you sort of newish MLOs, mortgage loan originators who are getting into the business, starting to try to get into some sales, and you're wondering, what's the process of getting through like a refinance transaction, which right now are basically the meat and potatoes of a lot of the, the pipelines of mortgage professionals right now. And what's the difference between that and a purchase transaction, which can be a little bit more time sensitive, can kind of feel a little bit, I don't know, make you feel nervous, and does have some sort of deadlines attached to it more often than not. So there's sometimes a little bit more skin in the game for the people involved on the purchase side. This video idea was a question that was posed to me in the comment of one of my other videos, so check that out in the little bubble up there, by a woman named Dominique Roberts. She wanted to know, what are the differences between a purchase transaction when you're writing a purchase loan and a refinance transaction? A little bit of background about me. I work for a sort of larger bulk online lender that serves every state almost in the country. I am licensed in 17 states myself, and I probably service anywhere from 15 to 25 loans every month, which is outrageous if you're familiar with mortgage loan origination and how many loans you can physically move through each month. I say that to sort of preface this to make sure that some of the things that I'm going to be recommended are going to be from that standpoint of where I'm working now. So a lot of the things are a little bit, more hands-off because we do have processing staff. We do have a support system that really takes a good amount of the work for getting documents off of my shoulders so that I can really focus a little bit more on the sales end. That being said, since I am licensed in so many states and since I receive inbound leads that are sort of fed to me, I am able to get through a lot of these refinance transactions. So those are the first ones I want to talk about. A refinance transaction in a nutshell is basically when you solicit somebody in order to restructure a loan that they already have on their home, a mortgage that they're already sort of possessing, and you want to just get them some kind of net tangible benefit. And that's a specific term that you might want to remember for your SAFE test. But basically what you want to do is you want to get those terms that they have now on their home and either cut off some time on the term, that is, say, going from a 15 to a 10-year, or a 30-year to a 20-year, something like that, so they can shave off some time. Or, getting them a much lower rate. I mean, that's usually the number one reason why people want to refinance their mortgage in the first place. Now is an especially salient time in the industry and in the history of the United States because we're sort of experiencing some of the lowest rates that we've ever seen in the nation's history. So we're getting a lot of refinance transactions in the works in our pipeline because sub-3 interest rates on certain types of loans have been unheard of up until now. Especially if you're in an outfit like mine that doesn't offer buy downs on points to get below a certain rate. So a rate on offer of sub-3 without any point buy down, that's almost unheard of in history. So we're getting a lot of refinances. The main first step in any refinance transaction is that you want them to sign the borrower disclosure agreements because there's a ton of different RESPA and TILA related borrower disclosures that you have to have them sign in order to get going on the loan in terms that you've negotiated and originated for them. This can almost feel like a second sales, and this also goes a lot of times with your purchase leads especially too, but for refinances it's especially interesting because you are competing with literally every other lender at all time. You can't walk a block without having a bank or a mortgage lending institution offering some kind of competitive rate or another. Get them the borrower disclosure agreements, get them to sign it, and starting the refinance transaction, that's a very big deal. Once you get people into the deal by starting them on the processing and the underwriting, it's very important to make sure that they are on top of their document submissions, especially if you're one of these lenders that doesn't really process a lot of loans in a very quick manner. Because for a lot of big online lenders, let's just face it, they're seeing so much business flooding in that they can't really close loans as fast as some more nimble or some more established loan outfits out there. Managing their expectations by saying, hey, look, this is going to go faster if we can get you to submit your documents that first day. And when I say those documents, if they are an employee, we need some W-2s. We need, obviously the W-2s. There's going to be any bank statements if there's assets needed for the refinance. We need to establish the qualifications for the loan by receiving the documents into the processing, but it's not necessarily as time sensitive or imperative from a processing perspective as it would be on a purchase transaction, and I'll get into that a little bit later. You see, on a refinance transaction, there's not as much obligation as there would be when you have more parties involved in the loan, like as in a purchase transaction. On a purchase transaction, you're going to see that you have the buyer to deal with, often the buyer's agent, and the seller as well, and they all have some skin in the game. So there's a lot more of an impetus on them to get things going, to get things submitted so that they can close on time. Well, there's no such rush on a refinance transaction, so we have to make sure that the emphasis is on us to make sure the process goes smoothly. Managing transactions, managing expectations for the buyer on how long things are going to take, and making sure that you're touching base in your pipeline every few days just to make sure that they feel comfortable with the terms. For me, a refinance transaction goes through the pipeline like this. You have the initial stage where I'm going out, I'm selling you, I get you into the borrower disclosure stage where I make you sign the borrower disclosures, I give you the terms of the loans and the loan estimate. Then we're going to move on to processing, and that's where, if you haven't already submitted all the documents already prior to that, we're going to sort of get all of the documents in from you so that we can get going on underwriting the loan. After the processing is all done, or at least the initial processing is done, we get you into the underwriting phase. That's where the underwriter takes a look at it, and if they're any good, they get it done in a couple of days, 3 days, 4 days at the most. They come back with a decision. Now, it's very important because in any mortgage transaction, you have to let your borrower know within 30 days whether or not you're going to approve them or if you're going to deny them. Before that 30-day period is up, you're either going to get notice to the borrower that yes, they're conditionally approved and here's all the conditions that we have to meet in order to make this loan happen for you at closing. Or the underwriter is going to come back to you and say, hey, look, there's some suspension items in here that we need to address. This doesn't really qualify as it is currently structured, and I either need to get back with the client to see if we can restructure it, maybe change the terms of the loan so that it's a cash out. Maybe we have to pay off some debt, or maybe we need to change the term to a slightly larger term so that we can lower the payment any way we need to, because the main reason things are in suspense usually is because the debt to income ratio is a little bit too high. That's not the only reason. I mean, there could be other reasons. They could have derogatory credit items on the credit report, or they could have issues with foreclosure, or the thing could be in a trust and we need to establish the trust agreement. And for my lending institution, we often don't close in a trust, so we would have to get it pulled out of a trust by a quitclaim. There's, whatever it is, we got to get it back out of suspense and either get it approved or just push it out the door and withdraw it or deny it by that 30-day mark, or it's just going to get automatically denied. So refinances, for me lately, usually taking 30 days. There are outfits out there that are doing it much faster, like in a week or so. But for me, that's how it's usually going. It usually takes at least 30 days to 45 days to get these things to close, if not a little bit longer. In the approval phase, it's all about checking off the conditions of the approval. Do all of these conditions match? Do we have the reserve requirements like bank statements and things like that established in the processing? If all of the conditions are met, we send it to the closer draws up the closing documents. I go over the closing documents with the client at least 3 days prior to closing, and then usually there's a couple of drafts of the closing documents that sort of make their rounds. We get the client to closing, and then the loan funds 4 days later. Now, that's because the client always has that 3-day rescission period after closing to sort of reconsider if they want to sort of take part in this transaction. And since it's just a transaction between the lender and the client, there's not as much urgency or there's not as much obligation as there would be. And that brings me to a purchase transaction, which is a whole nother ballpark. See, usually in a refinance transaction, it's all about getting the net tangible benefit, which means that we're giving them a better term, we're getting them a better rate, we're getting them something that they couldn't have gotten as their home was financed before. Whereas on a purchase transaction, the net tangible benefit of the transaction itself is we're going to get these folks a home. And, a home is a really good asset to have, right? When we talk about purchase transaction, we have two kinds of transactions rolled into one. We have the pre-approval, and this client can sort of be a little bit on the wishy-washy side, the wishy-washy end of things, because this is your client that's trying to dip his toe into the market. Maybe he's looking for a home, he has an idea of the kind of loan balance that he wants or the purchase price that he wants and the general area that he wants, but he doesn't necessarily have a contract. He doesn't necessarily know, in fact, even what the actual house that he wants is. So it can be a little bit of a struggle once you give somebody a pre-approval if you're manicuring that sort of relationship with that client to make sure that you're the one that they're going to end up using when they do pull the trigger on whatever eventual real estate that they do intend to put an offer on. A purchase transaction is creating the loan from nothing, right? So the balances on refinance transactions tend, not always, but tend to be a little bit smaller than on original purchase transactions, because generally mortgage loan originators are paid on somewhat of a commission, right? Somewhat of a commission based on a draw and everything. So the higher the loan balance, the more you end up making, and so you want to be hunting for these purchase transactions. However, beware. If you're doing a purchase transaction, you have to know your stuff, because these things come on a time frame, right? Once the contract comes in for the purchase transaction, there is a ticking clock associated with it more often than not. And in a really competitive real estate market, like we see right now, that can mean the difference between a deal falling through and a deal going through. And the finance contingency is not going to be the reason that you want your client to lose out on a deal, because that means that you're not only going to, be in bad straits with the client, but they're going to give you the opposite of referral, the antimatter of referrals, which is to say, don't use this lender. They're not going to get things done timely manner. That being said, if you've got a contract in hand with your client on a purchase transaction, you're going to want to start things off by getting to know your buyer and the buyer's agent, because both of these people are going to be integral to getting this thing done the way you want it. Because both the agent and the buyer are people that are trying to work in the best interest of the buyer, but you got to make sure that you are working in the best interest, and the obligation that you have under RESPA and ECOA and all of those is also being met by not revealing personal, non-public information about the buyer to anybody else, including the buyer's agent. You don't want to tell your buyer's agent that things are going bad ever. Things are always going great. We're just working on it. It may be taking a little bit longer. No matter how bad things are in the background, you want to make sure that you are constantly reassuring both the buyer's agent and the buyer. The pipeline for purchase transactions usually goes pretty similarly to refinance transactions, with the exception that there is no right to rescind in a purchase transaction, because there are three parties involved with that. There's money on the table, a lot of times earnest money that is non-refundable. There's also a lot more closing costs oftentimes associated with a purchase than with a refinance. And that has to do with a lot of survey and searches on title and things like this, establishing the ownership or the new ownership of the new home that they're buying. On the processing end of things, you're going to want to get that contract from the buyer and the buyer's agent. You're going to want to get all of the docs relating to their employment or self-employment status. And if they're self-employed, you really want to be on top of it. You want to get, 2 years personal and business bank statements. You want to make sure that the business and the income of the person who owns the business is profitable 2 years in a row, because that can derail the whole deal. And you want to make sure that these documents are well established in the first 1 or 2, 3 days max of the deal, so that we can get it out of processing, get it into underwriting as fast as possible. Another thing with a purchase transaction is oftentimes these buyers, these clients that you've acquired, they're going to have endgame closings that are already scheduled. So in refinances where we usually tell the clients when the closing could ostensibly be, it's the other way around where clients are saying, hey, look, this is when we're looking to close. This is when the seller expects us to be closed by. And this is finance contingent, so can you make that happen, right? Now, all things the same, it's the same kind of deal for the approval, right? We give a pre-approval based on what they give to us, but once it gets underwritten, we really get a sense of whether or not they qualify. Usually buyers on purchase deals tend not to be as sort of stretchy with the truth as refinance people tend to be, because they want to make sure that they're competitive for the deal that they're trying to get. So once we get them pre-approved in earnest after the underwriting process, we give all of that over to the party of people that's in our group, the buyer's agent, the buyer, and we make sure that they know that, hey, you guys are good to go. We also often send the buyer's agent notification that we've ordered title, that we have ordered appraisals through the appraisal management companies that we have. That's just sort of a courtesy thing that keeps people in your pocket after the closing goes through. Even if things do get derailed, they say, hey, look, these guys have been really communicative. One thing you're really going to notice about purchases rather than refinances is that the buyers are really, really invested, especially the ones with contracts. They're invested in getting to the closing. Not to say that refinances aren't, but these people are really, really invested in getting this thing closed, to getting their deal done, because that means that they're going to have property in their hands. They're only putting down 20%, but they're getting control of 100% of that real estate in most cases. So it's a pretty sweet deal for them. Now, at the closing, which is a really important phase of this purchase transaction, this is a non-rescindable transaction. So once these documents are signed by the buyer, by the seller, once they are witnessed by an attorney, if it's an attorney state, or a witness, or whatever, what have you, that's it. It's recorded on title and the ownership has been transferred. Usually you want them to happen on time, on the closing date that they come upon, so that when they fund, which is immediately, because at the closing you want to make sure that you wire the funds, or the buyer wires the funds to the appropriate people at the closing, so that the ownership can be transferred right there. At refinance transactions, however, you can be a little faster and looser with your timeline on payment. You can either show up to the closing with certified funds checks, and we can wait 3 days to make sure that those funds have cleared, or you can go ahead and do a wire transfer. But often, you can come to the closing and do the wire transfer and have it be in the 3-day rescission period, because just as long as it gets there before funding, hey, for the closing costs, you're good to go. I hope these little details about what it means to get a purchase lead and a refinance lead have been helpful. Once you get these purchase deals especially going, these can mean big commissions for you guys in the long run. I mean, for me, at this stage, I work on units, so I'd rather just pump out refinance deals all day long. But if you're on commission, nothing better than a purchase deal, because they get closed. Usually they get closed in a month or less if you're lucky, and they really yield much higher loan balances, which means much higher commissions. Okay guys, I really hope that I brought you some value with this information today. And if I did, if you like educational content like this, please give me that thumbs up, hit that notification bell, because I want to notify you about more videos like this, and I will see you in the next one. Peace guys.